What's going on, everyone? My name's Obi, and welcome back to the Courtside Financial podcast, where we break down the biggest news in business and tech without sugarcoating anything. Remember how we've been tracking NIO's financial pressures and their push for profitability by Q4? Well, they might have just found their ace in the hole, and that's selling off what many refer to as NIO's crown jewel. Plus, we've got some breaking news on Nvidia's highly anticipated Thor chip. It's facing some serious delays, and NIO may have positioned themselves to capitalize on this moment. So grab your coffee, put on your thinking caps, and let's dive into today's episode of the Courtside Financial podcast. Let's start with what might be the biggest plot twist in NIO's story yet. According to reports coming out within the last 24 hours, CATL, the battery giant, is having negotiations to acquire a stake in NIO Energy, the subsidiary of NIO that controls NIO's battery swapping stations. Now, if you've been following this podcast or just reading up on NIO, I've repeatedly highlighted how NIO's battery swapping moat is a key differentiator for the Chinese electric vehicle car company. They built this infrastructure over 7 years, 3,246 stations that complete over 88,000 swaps daily, and they've totaled 70 million battery swaps to date. It's their moat, their unique selling proposition, and part of their technological edge. And it's sounding like they could potentially be handing over control of it. My first reaction was, is this NIO waving the white flag? And that still very much might be a possibility. But looking deeper, this could be the strategic masterstroke that they so desperately needed. Here's what happened. CATL announced a 2.5 billion yuan investment in NIO Energy back in March, just last month, which would have given them a 25% stake based on NIO Energy's 10 billion valuation. My camera just died, but according to Reuters, CATL wasn't stopping there. Apparently, they're now negotiating for controlling stake, meaning 51% or greater. When asked to comment, CATL, they didn't deny it, simply stating that there's no further public information at this time. NIO's response was equally telling, stating that they're working with a number of investors, including CATL, to jointly promote the construction of their battery swapping station. The market reaction, NIO stock quickly jumped 6% on the news. Investors clearly see this as a positive, and here's why they might be right. Remember when I talked about NIO's record 22.4 billion yuan in 2024, and CEO William Lee's promise that they must achieve profitability by Q4 this year, which is coming up faster than we think. Well, the battery swapping business has been NIO's greatest strength and also their greatest financial burden. Building a single battery swapping station costs millions of dollars. Then you've got ongoing expenses, electricity, maintenance, staff. NIO's vice president Shen Fei stated that NIO needs to complete 50 swaps per station per day just to break even. While stations in Shanghai are apparently profitable with over 9,000 daily swaps, the rest of the network is bleeding cash, and those other stations likely won't be profitable for another 2 years. So obviously this creates a brutal catch-22 for NIO. Cutting investment in battery swapping stations would undermine their core competitive advantage, but continuing to build them at the current pace deepens the financial hole that they're in. As I noted in the last episode, NIO's debt to asset ratio is about 87%, and that's well above the industry standard of 50 to 70%. So what does NIO get out of this deal? First and probably most obvious is cash. This would significantly improve their balance sheet at a critical moment, but more importantly, they shed the burden of financing the expansion of the battery swapping network while still maintaining access to it. Think about it, even if CATL takes control, NIO and its customers would still use the service. The only difference is that NIO would be purchasing battery swapping services from CATL, and that's as opposed to funding the entire expansion themselves. Meanwhile, they could still advertise battery swapping and the battery swapping network as a key selling point for their vehicle. There's also an interesting personnel angle here. Remember Shen Fei, who I recently just brought up, like I'm talking in the last 30 seconds, as their VP who was running the battery swapping business. Well, also in yesterday's episode, he moved to become the president of Envo after the initial president's departure. This transfer makes even more sense if NIO was already planning to sell off their battery swapping business. Shenfei's primary responsibility was being removed anyway. So for CATL, this deal is equally strategic. CATL's revenue dropped 9.7% last year due to falling lithium prices, but also because of increased competition in the battery market. Many automakers are developing their own batteries, and that's obviously squeezing CATL's core competency, their core business. Meanwhile, CATL's energy storage business is booming, up 35% this year and representing nearly 20% of their shipment. 1 in 5 batteries that CATL sells is now for energy storage rather than vehicle propulsion. Battery swapping stations are essentially sophisticated energy storage systems. They maintain inventories of charged batteries and manage power distribution. By acquiring NIO's battery swapping network, CATL instantly transforms itself from being just a battery supplier to an energy service provider. And a really big cherry on top is that they now would have the largest battery swapping network in China. CATL entered the battery swapping business in 2022 with their chocolate battery swapping station, and they've been ambitious, planning 1,000 swap stations this year, 10,000 midterm, and eventually 30 to 40,000 long term. But they faced way too many challenges: lack of standardization across the different manufacturers, and also the massive investment required on their end. By acquiring NIO's already built battery swapping stations and probably going to get them at a discount, they're leapfrogging these obstacles. They get an established network with operational expertise and the know-how. NIO stations already account for nearly 40% of battery swapping stations all across China. And of course, they focus on the premium segment. More importantly, this gives CATL tremendous leverage in setting industry standards. As battery swapping scales up, CATL could push for standardized battery specifications and interfaces, potentially cementing their dominance in the power battery industry as competition continues to intensify and solidify. So from where I'm sitting, this looks like a genuine win-win. A win for NIO, a win for CATL. NIO lightens its financial load while maintaining a positive customer experience, and CATL accelerates its transition into an energy service provider while strengthening its position in the industry. And what about NIO customers? Theoretically, they shouldn't notice any difference. The stations will still be there, the service will still remain the same, and their battery swap guarantees should be honored. In fact, NIO is currently offering some pretty sweet promotions: 5 years 0 interest financing and 5 years of free battery swapping if you buy right now. That's either a desperate move to boost the April sales figures or a move to get customers to lock in these benefits before battery swapping stations transition away from NIO to CATL. Either way, it's an attractive offer if you've been eyeing a NIO vehicle. Now let's pivot to something that received less attention but could be significant for NIO's future: the ongoing drama in the autonomous chip market. Back in 2022, Nvidia CEO Jensen Huang announced the Thor chip with much fanfare. This was supposed to be the chip that would power the next generation of intelligent vehicles, with massive computing power and the ability to integrate functions like autonomous driving. Originally slated for mass production in 2024, the Thor chip has been delayed. The latest timeline suggests mid-2025 at its earliest, and even then, only the lower powered 750 TOPS version of it should be available, not the 2000 TOPS monster that was promised. These delays have disrupted planning for numerous automakers who were counting on Thor to power their next generation vehicle. Technical challenges are immense. Integrating multiple functions while managing power consumption, heat dissipation, and computing resource allocation is no small feat. But there are also other factors at play. Market dynamics have shifted, with some automakers being more conservative and not really want to make big investments into high-level autonomous driving. Additionally, the explosion of AI data center demand has Nvidia allocating more resources to chips for those purposes, like the H100, the H200, the B series, potentially at the expense of automotive chips. Supply chain constraints and geopolitical factors have also played a role, especially given that Thor reportedly uses TSMC's 3.4 nanometer or 4 nanometer processes, where production capacity is limited and tensions around semiconductor exports are pretty high right now, with everything going on. So this brings us to the most, or a rather interesting part of today's story, NIO developing their own self-driving chip, the Shenji NX. While most of the automotive world was quietly waiting for Nvidia's drive Thor, NIO's been inventing its own chip. The groundwork began back in 2021 and 2022. After more than 2 years of R&D, NIO unveiled the Shenji NX 9031 at NIO Day last December, and it's built on a 5 nanometer processor. So this chip is specifically designed to support NIO's NAD. For those of you who don't know, that's NIO's autonomous driving system. And I believe that the timing couldn't be better. With the Thor delayed until mid 2025 at the earliest, NIO plans to install the Shenji chip in the ET9, and that'll be the first model on their NT 3.0 platform. And in Q4 this year, they're planning on having a large scale production ramping up through 2025. So in my opinion, this puts NIO in a rare position. If this works out, other than Tesla, they would be the only automaker to successfully develop their own chip that serves this purpose. This gives them greater control over the technology stack and less dependence on suppliers like Nvidia, whose production priorities might not align with NIO's needs. Like I said, they're focusing on the data center right now. I'm not going to get too far into the technicals of this chip, but what you need to know is it should be highly performant, and it should offer lower latency than most things that are available on the market right now, if it's able to do what NIO says that it would be able to do. Of course, challenges remain. The 5 nanometer process still relies on TSMC, so production capacity and cost are going to be concerns. There's also the question of whether NIO can match the ecosystem of already established players like Nvidia, whose CUDA platform has been refined for over a decade. The competitive landscape in automotive chips is increasingly stratified. According to Gaogong Intelligent Automotive Research Institute, by 2025, foreign chips will dominate the Chinese automotive market by 70%, with self-developed chips accounting for only 30%. Even NIO will only likely use its Shenji chip in 10 to 20% of its vehicles initially. If their 2025 production target is 500k vehicles, 500,000, and the Shenji penetration rate is 20%, they'd still need to purchase 400,000 chips from Nvidia or Qualcomm. But here's where it gets interesting. It seems as if the entire industry is moving towards a greater integration of vehicle and cockpit, similar to what Nvidia's drive Thor has promised. And so NIO appears to be positioning the Shenji chip is something that is capable of fulfilling this role, fulfilling a need that all of these customers who have highly anticipated the Thor chip are waiting for. There's even speculation that NIO could supply this chip eventually to other automakers, similar to how Huawei provides its MDC platform to other car companies. So this would open up an entirely new revenue stream for NIO. You don't have to think too hard about that. It'd be a good thing. In many ways, this parallels Tesla's approach. Tesla initially relied heavily on Nvidia's chips, but eventually developed its own silicon to better serve their needs. So this vertical integration gave Tesla an advantage in performance, cost, and supply chain resilience. If you want to be a part of the conversation before it happens here on YouTube, click that link in the description to join the free Courtside Financial Discord. So let's zoom out and talk about everything we talked about today as a whole. On the one hand, NIO appears to potentially be divesting a capital-intensive business, while innovative battery swapping has, without a doubt, been a financial drain on NIO. On the other hand, they're investing in high-value intellectual property that could differentiate their vehicle and provide the company with a new revenue stream. These moves represent a more financially disciplined and mature NIO than we've seen over the years. One focused on leveraging their technological innovations without necessarily owning every piece of infrastructure. It's a recognition that in a capital-intensive industry like automotive, strategic partnerships and focused investments may serve to be more practical and useful and helpful than trying to do everything in-house and on your own. It's clear that NIO's making some bold moves at a pivotal moment rather than being stubborn and trying to, how do you say, fit a square peg in a round hole. So we'll have to continue watching to see how the story ultimately plays out. That's it for this episode. Make sure you hit the subscribe button if you're new here. Share the video. Leave a comment down below. I like to hear your guys' thoughts. I like to have discourse. I appreciate you tuning in, and we'll catch you in the next episode. Peace out.